Penny stocks. The very mention either causes excitement or fear. The topic even inspired a major motion picture starring Leonardo DiCaprio, The Wolf of Wall Street. The truth about penny stocks, however, is that this class of investment can and routinely does return the biggest profits of any kind, bar none. Penny stocks, after all, are usually nothing more than shares of very small, early-stage companies that are in their startup phase. That opens up the possibility for growth, the most you can find anywhere in the public markets, in fact. Some have even gone so far as to call penny stock investing the common man's venture capitalism. When you buy penny stocks, your goal should be to own the next Facebook, the next Apple, or the next Google, before the company hits its stride and becomes a globally recognized brand. Of course, the goal and the reality are often far apart, and the reason boils down to one word: risk. Whenever potential is great, so is risk, which makes the process of vetting potential investments that much more important. Choosing the right company can be confusing or even frustrating, but there is a way to remove unnecessary risk while maintaining all of that precious profit potential. Over the course of my career, I've found that there are 5 ways to cut risk from penny stocks. Each step cuts out unnecessary uncertainty and shortens the list of potential companies. Do it right, and you can reduce the field of candidates and the associated risk by as much as 99%. Here is what I look for. Avoid the dividends. Early-stage companies need to be reinvesting their cash, not doling out profits. If you want to make money off dividends, stick with the big blue chips. Reinvest the dividend proceeds and hold for the long term. In the world of penny stocks, dividends are parasitic. Cash reserves. This implies a healthy, stabilized debt-to-equity ratio. This means a company has the money to research and develop products, market itself, hire new staff, and buy new equipment. If the company is a body, the cash is the blood. Strong profit margins. A good profit margin isn't essential, but it's indicative of stability and future growth. Focusing on companies with decent margins is an excellent way to cut out risk. Does it cut out potential upside too? Yes, it does, for the simple reason that companies experience their biggest share price gains when they cross the line into profitability. That said, companies with a strong pulse tend to grow without the same risk exposure. Gross margins of 50% or better. This implies that the business model works and will continue to keep the company profitable moving forward. More risk excluded in return for higher chances of long-term growth. This is how you turn a penny stock wildcard into a mid-cap standout. Tight share structure. Fewer shares for a small company means 2 things. First, individual shares will be valued higher and thus carry an appearance of stability. Second, positive news will have a stronger effect on trading volume as a percentage of total market capitalization. In short, good news will drive gains faster. To illustrate this process in action, use a simple stock screening tool like the one available on Google Finance to see just how much of the total penny stock field is excluded with each parameter. Properly applied, 20,000 plus companies that fall into the microcap category can be cut down to fewer than 100. That's already better than 99% exclusion, removing a large majority of needless risk and focusing on the best short to mid-term investment possibilities. Of course, the process doesn't end there. You still need to cut that field of 100 or so down to a field of just several. That requires a bit more of an organic, hands-on vetting process. But the good news is, it's a process that almost all investors, even beginners, are already familiar with. Go through the companies one by one and see what's actually happening in the news. New product releases, new acquisitions, big names added to the boards of directors, and the like will bring out the true superstars. Common things to look out for in this stage of the process are lawsuits and regulatory problems. You don't need to deal with these hazards, so exclude them even if everything else looks good. What do you want to see? Major new contracts, industry awards, new patents, or news concerning impending FDA trials and approvals are huge. When it comes to the mining sector, where many great penny stocks live, be on the lookout for new property acquisitions, as well as recent drill test results and announcements regarding commencement of operations. At the end of the day, it's impossible to cut out all of the risk, but that's just the nature of the business. No company, whether it's microcap or large cap, can guarantee a better tomorrow. Take the mathematical, emotionless approach in eliminating those with unreasonable risk, however, and your deck will be stacked from the get-go.
If you like this video, please make sure to subscribe to the Wealth Daily YouTube channel using the button below. For even more investing tips and commentary, sign up for our free newsletter right here.